Welcome to the weekly update, where I'll go over the action in the market for the week of June 3rd through the 7th, and then we'll see how things look for the week of June 10th through the 14th. We had an up week. It was a very interesting week in that not much happened. There was a lot of anticipation for the employment situation report on Friday. It came, it was stronger than expected. Interest rates ended up going up. And stocks tried to go up, but really weren't able to do that. The fact that they're not going down can be seen as positive. But at the same time, in the daily videos, I've been pointing out some areas of weakness that are kind of under the surface and they're kind of big, but they could get taken care of if we really see some strength coming back into the market. If we don't see that, they're just continuing to build and have been for about the last week or so. And eventually we wonder, is that going to lead to something? Okay, before I get started, please know that I do post videos every day. Now, they're locked down. They're not available for that day until the market closes. If you want to have access for the month of June, I have a website and a program that's free for right now. Eventually, I'm going to be locking that down probably in July. But that's the real foundation of my analysis and commentary. This video, as important as it is, and I know a lot of you, this is all you can watch. If you really want to know what I'm looking at and what I'm concluding as far as what's happening, it's really at the daily videos. All the other weekly videos, they're just supplemental to this. There is a PDF that's available in the description below every video that I post. There are a thing called pivot points, which I post each day on the YouTube community tab. I can't do this on Rumble. There's two charts. One, it's a daily chart, but the pivot points last for a month. And I just update it with that day's bar. The other one is different every day, and it's an intraday pivot point chart, and you might find that useful for support or resistance. There is a private Facebook group, not a lot of activity in there. If you want to join, maybe have some activity starting, you're welcome to do that. I'm focusing a little bit more on the program itself, but I still want to keep the Facebook group there in case you want to join. You don't necessarily want to become a member. We can still have a back and forth that way. I am really watching YouTube and Rumble comments. You would not believe how many marketing and SEO and video experts there are. I get 2 or 3 a day posting comments, especially on Rumble. I haven't really been getting them on YouTube. And they tell me what an expert they are and how I have this loser channel and they can really turn everything around. I just delete those things. I wish we had a number of economists that were experts, or scientists, or politicians that were actually experts at other than just talking. The world is full of marketing experts, especially on Rumble. It's not true. They're going to some webinar and they learn some little scheme to try to convince you that they know what they're talking about. And everybody's teaching the same thing. And I've learned all those things before, and most of them don't even work. So I just go through and I delete those comments. If you want to leave a legitimate comment, pro, con, question, a conclusion that you've reached, that is totally fine. But I really watch the comments closely. I get rid of all the crap comments because I want it to be an authentic back and forth. I also post on Rumble, and sometimes I have uploading problems. Now, a week or so ago, I had an internet throttle back due to a geopolitical event that was happening, and that can happen. I was able to finally post to YouTube after a few hours. It took me 7 or 8 hours just to upload a video to Rumble, and that can happen. Here is the link to Rumble. Also know that I do have the SPXInvesting Program. It is now launched. And as I said, it's free for the month of June as I'm trying to roll things out and work out bugs and just try to figure out the logistics of everything. Here is an email. If you want to talk to me about that, you can contact me directly. There are links about the program to a number of videos that I've uploaded. And there's also a link to access the site in the description below this video. Please feel free to check that out. It's All it's going to cost you right now is an email address. And if you don't like it, you can just unsubscribe and poof, that's all there was to that. Another thing I want to make aware to some of you, because you only watch the weekly videos, and I understand that you're busy, you can only really catch up with your portfolio or your retirement or whatever's happening over the weekend. There's another video that I try to watch once a week, and it's a weekly video. It's a guy named Chris Shavako. I finally learned how to pronounce his name. I really like his insight, but he's much longer term than I am, and he uses a lot of different things that I don't use. I watch it every week. I've learned some things from him. I don't know him. He doesn't know me. I just watch his videos. I don't think he watches any of mine. I'm not connected with him in any way. But if you get something out of the video that I post, you might also get something out of the video that he posts each week. Here, this is a screenshot of his YouTube channel. So feel free to check that out if you would like. I just wanted to pass that on. I believe in giving folks the best information I can, whether you're a member or not a member. I'm an educator, and that's kind of what I like to do. Let's go back and talk about this week's session. For the week, we were up 1.32%. Volume is still below average. We kind of got up to average one day, and that was a down day. But even in Friday's session with the all-important employment situation report, we just were well below average that day. To be setting all-time highs on a decrease in volume is a concern. Now, the perma bears are just latching onto that for sure. We ultimately have to follow price, and volume can come back. And yes, there are things that take place off of the exchanges that doesn't really count as volume, but we have to go with what we have. And this is a classic textbook negative divergence. When you see price going up and volume going down, hasn't really led to anything yet, and it may correct itself. We just want to be aware of that. We are positive with our technicals right now, but there are some areas of concern. We're switching back and looking more positive on the daily charts, but there are some real kind of not just things to worry about. These are like kind of big and could become even bigger unless they get dealt with. So there are also some things that I'll go through here in these charts. And it's about inflation and interest rates. Now, in the upcoming week, we're going to get CPI, PPI, and the Fed is going to be meeting, and then they'll make their announcement. They're not going to change rates. It's pretty much locked in that won't happen. But it's what they say, not only in their statement. They've got this little report that comes out now. And then what is Jerome Powell going to say in the press conference after that? And the market's going to hang on every word. We are still in a weakening trend. Now, it's a positive trend, but it's coming down, and I'll show you this chart. The green line is still above the red line. That's what makes it positive. So major indices, and this is actually the correct way to say this. I know I say indexes. In America, we say indexes. In the UK, they say indices, and that's really the proper way to do it. We did have gains in the major indices due to mega caps. They had a pretty good week. Specifically, NVIDIA, it got up over $3 trillion in market value. My goodness. On a closing basis for the first time ever. And there are concerns about economic growth because we saw some weaker than expected economic reports coming out. And then the ISM came in stronger than expected, and the market could be going and shifting back to where good news is good news and bad news is bad news. It's been the opposite of that for quite a while now. The market wants the economy to hang in there, but it doesn't want it to fall apart. Not like the bond market. They really want it to fall apart. But we just watch for this subtle shift from one end to the other. The European Central Bank did cut rates. Even though they have inflation worries in Europe, they still kind of promised that they would do that. So they actually went through and did it. Interest rates ended up closing. We were at 4.43% with the 10-year yield, where we had been at 4.51%. So those did decline. Now, we were up on Friday, but on the week, we ended up being down, and the dollar was also lower. The dollar index, that together with interest rates declining and the dollar under some weakness, that gave support to stocks. Here is the different indexes. Here are the indexes. The Dow was up 0.3%. It's still having a little bit of trouble. The NASDAQ was up 2.4%. The S&P was up 1.3%. And not to be outdone as usual, the small caps, as denoted here by the Russell 2000, they were down 2.1%. And I'm not involved with the small caps myself, but I know a lot of people that watch these videos are. And it's been a really frustrating 2024. And I feel your pain there. This is a chart that I've been showing for a year now. And it is a little outdated, but this is a very long-term chart. This gold line is kind of what's been happening with inflation, as we're still kind of swinging down here and going lower. Okay, and this is matching up with what happened from 1966 through 1982. Now, there's no guarantee that we're going to continue on this same path. The one thing I want to make clear, and what I stress every week with this video, is look what happened after that. This is in the mid to late 70s when we saw massive inflation. Is that going to happen this time? Depends on what video you click on. My personal take is maybe, maybe not. We just evaluate things as the information comes to us. That's why I do the daily videos, because we can see things starting to develop before they actually happen. And so we're going to be well ahead of what's going on. And that's why I stress watching the daily videos to see if they'll help you. But we might see some kind of inflation. But, there's people out there saying, yeah, we're going to the moon with inflation. Other people like, no, it's going to stay under control. And it'll probably deviate from the same pattern at some point and kind of create its own. This is some RenMac research that came out. I've been showing this for months and months as well. And they have concluded that when we're above 4.02% with the 10-year yield, that's when it starts biting into corporate profits. Well, we closed at 4.43%. Some Isabel Net blog charts. This is pretty much the same chart. I just update it each week. What we take from this is you see how we're seeing a gradual increase of earnings per share, whether it's Morgan Stanley or the consensus. That's what we want to see, and that justifies stock prices going higher. Then we're looking at some equity fund flows where we saw a lot of money coming out when we look at a 12-period moving average, even though it was up for equities right here. As we were starting to hit some problems in April and early part of May, folks were taking some money off the table, but it's still positive. We haven't actually crossed below zero. They're not just putting as much money in as they were before. This comes out whenever we get the employment situation report. This is warning that a potential recession could happen. Now, we have other charts that suggest that it's not going to happen. This is just one chart. You don't want to base a whole scenario on just one thing that you see. But other times when this red line, which are all employees, temporary help services, when this drops down below the red line, typically, boom, we go into a recession. That's this grayed out area. That happened back in 2000. It happened back in 2008. It did happen during the COVID plunge, but we V'd up out of that. Well, we dropped down below it, but so far to this point, we have not gone into a recession. Is it going to happen? We're just watching things and seeing how things develop as the information becomes available. Looking at zero risk premium in crude right now. This is a ratio between oil and gold. And right now, oil is really underperforming gold. Oil has been pulling back, believe it or not. Even with all the geopolitical things, it's shot up there, but then it came back down to 80, and now it was even in the low 70s for a while. Now it's about the mid 70s currently, as gold has been going up. And so that's why we're seeing this ratio going down. When this gets really low, that might be, according to this chart. Now, I don't, this is not my area, but this is an area where other folks, they may start buying oil and selling gold just as a trading type of position. When this gets really high, that's when they start selling oil and buying gold. And so we're just seeing a real deviation right now between the two. Now, this is the 10-year yield. And I have to tell you, and some of you that are listening to this are going to completely disagree with what I'm about to say. This is based on Elliott Wave. I do not like Elliott Wave. Not because Elliott Wave, he was probably a nice guy, and I like the system, but 10 people can look at this same chart and come up with different numbers on this chart. That's the problem that I have with it. I spent a lot of money about 20 years ago on some software where it would automatically draw the waves for me. and then things would change, and then it would redraw and come up with completely different numbers. So it was great at telling me what I should have done after the fact. I could just look at a bar chart and do that. So I'm not a big Elliott Wave fan. Plus, the folks, as a general rule, there's always exceptions. The folks that really lean on Elliott Wave, they always have a down arrow for stocks and an up arrow for gold, no matter what's happening. They always conclude that. And there's some perma bears that I follow, and they're just sure the market's getting ready to fall off a cliff. If you were looking at a stock chart, this is the 10-year yield. Now, this is the interest rate. This is not the price. And we've been going back up, and now they think that we're coming back down to this moving average, and we potentially could start going up with interest rates again. Well, over the past week, we've actually seen a decline, and we have an RSI, which has been coming down, and we have a MACD, which is looking at possibly crossing over negative, but we're right on a moving average. Now, I can take that away from the chart. All these little numbers in here, they're all gobbledygook to me, because some little move can change in here, and all these numbers would change with it. That's where I come out. And I've studied this stuff deeply and read many books. I've tried to implement this, and I just have concluded it's not for me. If it's for you, great, go for it. FactSet had one blog post. It says fewer companies are actually saying recession when they have their earnings calls. That's really dropping off. And so the recession, okay, citations. My goodness, can't they just say recession? It is higher, where they're talking about a soft landing, but not quite as much. Now, you can take that as positive, meaning that maybe a lot of these companies are not really worried about a recession right now. That could be good. At the same time, if things really do turn, there's a negative side to this, and we start to get really soft economically, and things really start to decline in the economy, that's going to catch a lot of these companies off guard. And so we just want to watch things. They don't seem to be as concerned about it right now, but that could change quick if the economic reports start to suggest that. Then, looking at our intraday chart, we go back to Monday, where we did have a higher open. We had that really strong close on the last day of May, and then we gapped higher and then spent the day coming down. We saw a little bit of a bounce. Tuesday was really quiet. We did gap higher, and this was the strongest day of the week, intraday anyway. We gapped higher, fell back a little bit, and then just shot up. That was really positive, and that's when we switched back over to looking more positive. Believe it or not, in the past week, I've had long and short positions at the same time, because we were getting positive signals, and so I was going with those and doing some strategies. We also had some negative signals, and I've been going with those. What's really cool is when they all turn out to be profitable. I don't know if that's going to work out yet or not. Few of them have already. And I even have a number of market neutral positions right now, because we're not trending on the daily chart. So I'm setting all of those up at the same time, and you can take advantage of market movements even in the same time frame using different strategies. Then on Thursday, this was very quiet, a real comatose day, because everybody was getting ready for the employment situation report. And then the report came out, and it was stronger than expected. We gapped lower, went up, and then, interest rates are too high. Let's fall back down. Oh, no, let's go higher again. Nope, let's fall down. I mean, my goodness, we just chopped around and ended up going nowhere and closed slightly lower in Friday's session, but we were still up on the week. So this is just the 5 trading days, looking at the indexes. All of the indexes, well, I shouldn't say that. The NASDAQ 100, the S&P, and the Dow, they were up. The NYSE, which is a broad market measure, the mid caps, which are not showing a lot of strength right now, and they had been up until a few weeks ago. And then the small caps, they're down, and they're kind of the weakest area currently, and have been in 2024. Going back to the beginning of the year, all of the indexes are up. Small caps are now back to being down on the year. Different sectors. This is just the 5 trading days, not Friday to Friday. It's Monday through Friday, where we had tech, and this was This was majorly done by the mega caps, tech sector. And then healthcare was just up a teeny tiny little bit, and all the other sectors during the 5 trading days ended up being down. So it was the mega caps and it was tech that really led the market higher. Going back to the beginning of the year, communication and tech are positive. All of the other sectors that we follow are negative, with real estate in last place and discretionary, which we wanted to do better, but this is really getting dragged down by Tesla. This is a relative rotation graph, and you have to remember back to your geometry class in school when you had an x-axis and a y-axis. Well, the upper right, that's plus plus, and these are the strongest areas. Over here on the side, these are the 11 S&P sectors. And energy has been strong. Now, this goes back over a year, not over the last week or month or what have you. And if you want me to vary these things, send me a comment. Let me know. Because there's a lot of different ways I can arrange these around. But energy had been strong, but to see this really long tail here, it's starting to show some weakness. Utilities had been strong, starting to roll over a little bit. And then we have other areas that are showing some weakness like materials. Communication is starting to look strong again. That's tech. And then we see the financial sector showing a little bit of weakness, industrials, a little bit of weakness. And then over here, we have okay, this is communication. I was wrong. Over here, XLK, that's tech. Then we have healthcare. This is staples right now. Sorry, my mistake again. This is discretionary. And then way over here, doing about the worst is real estate. Okay, then this is a chart that goes with that same graph that we just looked at, showing how over the last year we have utilities, strong energy, even though they're pulling back. The line here, that's how much momentum is going on in communication. Then we have the materials, and then kind of in the middle are staples, industrials, financials. And then real estate has the longest tail, followed by discretionary. We want this to do better. It's just not. Then healthcare, which is a defensive area. That's what we're watching. We're really keeping an eye on utilities, staples, and healthcare, because we were setting all-time highs with those three areas doing well. That's what happened at the end of 2021. Doesn't mean the market's going to fall apart like it did in 2022, but when those things happen, we just want to keep an eye on those things to see if something bad is developing. Then down here at the bottom is tech. So even though it's doing well over the last year, it's been underperforming a lot of these other sectors. Here's another relative rotation graph, just looking at the different indexes, where we have the OEX, that's the S&P 100, and the S&P 500, that's what I follow the most. We have the NASDAQ 100, which was showing some weakness and now starting to make a comeback. Mid caps had been strong, and now they're starting to show some weakness. This is the Dow Jones Composite Average with the Dow, the transports, and the utilities together. It's been showing a bit of strength with the Dow doing better earlier on, and then utilities coming on strong. This one I can't even read. And then over here are the transports. They are really underperforming. That's been a real drag on the market too. We've seen small caps and the transports really underperforming. If those could suddenly turn around, that would really help the overall market environment. Here's the same chart showing how the S&P 100, which are the biggest stocks that make up the S&P 500, and I have a chart comparing these two later. They're doing the best, and then utilities are doing fairly well, the composite, the NASDAQ 100. Negative are the transport, small caps, and now the mid caps, which had been stronger, but now they're starting to see some weakness. And then I compare this symbol at the bottom. That's the Wilshire 5000. That's a broad market measure that I use. Where with the other chart, I compare the sectors with the SPY, which is the ETF for the S&P 500. Looking at sentiment, we closed at 45 after Friday. We also closed there at 45 after Thursday. This is showing how sentiment has been coming down as the market was under a bit of pressure, but then we bounced back up just a little bit. We're not extreme right now. When we get above 75 or below 25, that's when we consider using this as a contrarian indicator. When it's trending up, we tend to go with that. That means things are looking more positive. When this is going down, that means things that are turning more negative. And here's the active asset managers. They're still above this really high reading here. And even though these are professionals, they have people they have to answer to. They're human beings. They have emotions. When they start really getting hot and heavy, which is what they're doing now, even though they could go higher, that's when we start to look at using this as a contrarian indicator. But it may take some time for this to play out. This is that same chart showing how okay, what's the deal here? How come I'm getting very different readings? Okay, it actually fell. This was updated on June 7th. This was updated on June 5th. Okay, disregard this. I'm seeing a discrepancy here. This is the VIX. This is the fear gauge where we started to go back up, but then we're coming back down with the VIX. That's what the line chart. That's just the closing week after week. This is the bar chart for the whole week. And also we ended up closing down quite low. There's not a lot of fear in the market. This is another sentiment indicator where we get above this dashed line. Maybe we're getting a little too happy. Now, that's not being confirmed by the VIX. Well, it is kind of being confirmed by the VIX. But by the sentiment gauge, the fear and greed index, that's more neutral, even a little bit negative right now. So we're seeing some discrepancy across the board. The Ulcer index, this is another fear gauge. When this is going above the moving average and going up, that's an ulcer. You're freaking out at that point, and it's not doing that at this time. This is the spread between risky and not as risky bonds. This is very similar to the VIX. This has been going down, and that just means that there's not a lot of fear in the bond market. Now, I have some additional things to go with this. Here is the VIX with that same spread that we just looked at, and you can see how these really track each other very closely. Not a lot of fear when we look at the VIX, not a lot of fear when we look at the bond spread. Then this is taking the same things that we just looked at and flipping them upside down. Because up on top, we have the S&P, which is coming off of setting a new all-time high. It set a new intraday all-time high on Friday, but not a closing high. And just to make it a little more logical here, this is that same spread. Even though it's coming down, it's still giving us a fairly high reading. This is that same chart, but flipped upside down. It's inverted. And then this is the VIX, which is giving us a very low reading because it's very high on this chart because this is also inverted. This just means, now we keep a little eye on this because bonds have been under pressure, especially in Friday's session. And interest rates have been going down, which have been helping stocks. So we're just keeping an eye in this area. But this isn't necessarily giving us any real warning signs according to this chart. Then we get the investors' intelligence. These are the folks that send out newsletters and make recommendations and blah, 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 blah. They had been quite positive. We're still above 3 in the latest reading at 3.16. This could go higher if we go up. This will probably drop lower if we go down, since these folks tend to react, even though they're professionals and they're supposed to be geniuses and tell you what to do, they tend to react to what's happened already. This, and I feel really bad for these folks. These are people that get into the Ridex. When the market's going up, they have bullish mutual funds. And when we're going down, they have bearish mutual funds. And when I first started this whole program well over 20 years ago, this is all I had. The ETFs let me try that again. The ETFs had not established themselves enough yet. So I was using mutual funds to do this. When this goes up, that means people are freaking out and they're getting nervous. When this gets really low, this is like the VIX. That means that the market's going to go higher. Well, they tend to they react to what's already happened. And if we have a monster down day, they get into the bearish funds. And then if we have a monster up day, they lose in the one fund and they jump into the other fund only to see that go down the day after. And it's like a ping pong match. And I feel bad for these folks. Then the latest reading from the American Association of Individual Investors, it did drop down, but we still see where the moving average is going up. So it's still positive, not giving us an extreme reading. This is another measure against cash versus the tech sector. And I know it goes against logic, but when this is going down, that means tech is outperforming cash. You would have been better off in cash in 2022 as cash was outperforming. Now, as this line keeps going down, that means the tech sector is outperforming, and that's positive. The latest reading from GDP Now, coming in at about 2.5% for GDP. They are coming down with their forecast, but it's still positive. And then when you look at the forecast, we have about 3% to the upside and about 1.5% to the downside. This is showing this as bar column form here. We're mainly focusing on this last column right now. The takeaway from this is that all of these are still above zero. If we see 2 of these go negative back-to-back quarters, that's one part of why we're probably in a recession. Looking at the Chicago Financial Conditions Index, we're below the black line and declining. We get nervous if we go above the black line. This is a little bit of a concern. We finally had an update on Friday with the real-time SOM rule recession indicator. They can't come up with short names for these things. We're coming up above the black line, okay? We start to get nervous if we go above the red line. Now, it's going to be another month. I don't know why they call this real time, because we're not going to get another reading until July. But if we go above the red line, that is when we start to get concerned. Also, the smooth U.S. recession probabilities, we did really drop down. This is the latest reading. We're below the black line. We get nervous if we go above the red line. Then the Brave Butters, finally, since the end of whenever it was, we got an update here, and this is coming down. Now, this is a quarterly report, and I don't know why they call it leading, because it's already happened by the time we get the memory. But this is looking a little more non-recessionary in its reading. Looking at inflation, this is updated every day, and it measures CPI and PCE inflation, and these adjust as reports come out and things happen and so forth. And then here's what's going to happen with the Fed based on what the market thinks. This is as of Friday's close. At the meeting coming up on the 12th of June, there's a 97.8% chance that they will leave rates unchanged. This is how that has changed. It's even gotten more locked in. This is right now, dark blue, day ago, week ago, month ago. So the market's even become more convinced that the Fed's going to leave rates unchanged. Now we start looking out to the July 31st meeting. Right now, there's a 91.8% chance that they're going to leave rates unchanged at that meeting too. And this is even getting more locked in right now. And then we start looking out into September. This is where we see the possibility of the market thinking, the Fed may cut rates, because we're seeing this at 46, this at 49, the 49.5%, that's leaving rates unchanged. If we get a cut, about almost half of the market right now thinks that's what will happen. As we get economic reports, as the market goes up and down, depending on all the crazy things that could happen between now and September, this will change. And this may even get locked into being unchanged, and then we'll have to go to the next Fed meeting after this. And this is how it has changed. In fact, the market has become a little bit more convinced right now that the rates are going to be unchanged, where it had dropped off slightly, where they were pretty much expecting a rate cut then. This is the Fed balance sheet, the change where it is going down. But if you look over here, it actually has a positive number. So it's going up slightly. This is a year-over-year change, where this is kind of looks like it's almost going up a little bit, and we see a negative number here. Kind of interesting. This is new to the video, and I was looking at this throughout the week, and this can be hard to understand because it has like triple positives in it. This is overnight. Okay, that's easy to understand. Reverse, meaning instead of going forward, you're going backward. Repurchase. Okay, so you bought something and you're going to buy it again. So, and you're going to reverse that. You see, they play with all these stupid terms and get you all screwed up. Here's a definition from Investopedia. A reverse repurchase agreement is a short-term agreement to sell securities. And this is usually the Fed that does this. They're going to sell them back at a higher price. They're going to be able to sell them at a lower. Okay, they're going to buy them, sell them in order to buy them back at a higher price. And this is the Fed's way. They're going to eat the money there to help the banks stay solvent. Now, we saw a little blip up. This is during the COVID crash and all the crazy things there. And then we kind of got back to normal for a while. And then we saw this really picking up. And a lot of people think this is what was keeping the banks together without really going under, without really having a lot of problems. We topped out right here at the end of about partway through 2022. This is when the stock market, right around in this area, it bottomed in October of 2022. And now, as stocks have been going up, we've been seeing this continue to go down. That's kind of the takeaway for right now. Now, there's people that discuss this ad nauseum and throw all this stuff at you and have all these conclusions. We'll just keep following this chart, comparing it to what's going on in the market, and see if there's any influence here. All right, looking at our advanced decline line, We turned down a little bit this week, which is strange because we had an up week. We're also seeing a little bit of weakness based on price. But the encouraging thing is it's holding up better based on volume. And we're seeing that on the daily chart and right here on the weekly chart. The new highs, new lows, they are tapering off. And it's not because we're seeing an expansion of new lows. It's because we're seeing a contraction of new highs. So we're going down with our 4-week and our 10-week. Advanced decline ratio did decline, but we're still above zero, both with a 19-week and a 39-week ratio that we follow. This is a smart money indicator. We're looking positive on the daily chart. We're also looking positive here on the weekly chart, so they are confirming each other. Here's our trend. We are positive with the green line on top, and it's been kind of choppy lately. It's a weakening trend because we've dropped below the moving average, but it's still a trending environment until we come down and drop below 20. Now, the reason why I've been doing these long and short positions on the daily charts is that we're well down below 20 with the ADX. That means a non-trending environment, and that's when you start to implement sideways types of strategies. On a weekly basis, you wouldn't do that. Even though this is declining, it's still a trending environment, and this could kick back into gear at any time, either to the upside or to the downside. This is the Arun indicator. The green line measures buyers. The red line measures sellers. We're pegged pretty much at the top now. This is positive. When we're above zero, that is positive, but we really can't go any higher than the reading. Well, it's at 100, and that's as high as this will go. The mass index is not generating a signal. I'm not going to go through that. Here is a daily chart where we came down almost to the 50-day moving average, and we bounced up off of that. And we're not really seeing any overhead resistance right now, at least in the S&P, based on pivot points. There's other things that will provide plenty of overhead resistance. We're just not seeing it on this chart. And then down here, now this is a daily chart, but you can see as we started to finish out the week, how volume was just dropping off. This is the Keller market model, where the S&P is positive across the board in the short, intermediate, and long term. The mid caps are negative in the short term when they've been a stronger area up until recently. Small caps, not a surprise there in the short term. The NASDAQ 100 is also positive, and all the other time frames are positive currently. Then we look at kind of an intermarket analysis thing here. Stocks are positive across the board. Bonds are now positive in the short term, but negative in the intermediate to long term. Commodities are negative in the short term, but positive in the intermediate to long term. The dollar now has switched back to being positive across the board where it was showing some weakness. It had a big up day on Friday. This is the decision point scorecard. According to their trend models, positive across the board. Their PMO signals, positive in the short and long term, but negative in the intermediate term. But be aware of this. They updated this like days after it actually happened. Then looking at our trend channel, we're still well above the midpoint and looking really good when we go back to 2009. This is the pivot points. We're well above this R1 level. And if we keep going up, I'll have to break out this chart again because this may act as overhead resistance, but we're still far away from that. On a trending basis, we have a 50-week moving average. That's the red line. It's going up and price is going up, looking positive there. Then this next one is a moving average crossover. The blue line is above the red line, and we're above both lines. That's positive longer term. This is a little bit negative. The McClellan oscillator is dropped below zero and is declining. This is one of the danger signs we're seeing on the daily charts. Even though we've been going up with the S&P, the McClellan oscillator is negative. And that affects the next chart, which is the summation index, where we have been declining. We're actually negative and going down based on price, looking a little bit better here based on volume, but this is a concern to us. We ticked up a little bit with the Swenlin trading oscillator. We've actually turned half negative on the daily chart. Price has dropped negative, volume has not quite. But we came up a little bit, but we're still negative based on price. We're actually turning more positive based on volume. And when I say volume is actually doing a little bit better, this is one of those charts that's showing that. This is the bullish percent index where we're trying to go back up. This is still positive, but it has been declining lately. It won't go negative until we drop below 50. Here's another momentum oscillator, the PMO, where we're starting to flatten out on the weekly chart. We came down, but we're still positive based on price and volume. These are some studies that go with the PMO. So it looks at all the stocks in the S&P 500 and says, oh, what are the percent of the PMOs that are going up? Well, that's declining. on an up week. Kind of a little concerned. The number of buy signals, that actually ticked up. And then the PMOs that are above zero, that continues to decline. And we're seeing a mix like this on the daily charts, at least after Friday. The Bollinger Bands percent B, there's a whole books on how you can use Bollinger Bands. I just use them on this chart for when we close above or below the Bollinger Band, because that doesn't happen very often. We're not extreme right now. These are our weekly oscillators, the shortest term of slope and the TSI. The slope is continuing to decline. The TSI is trying to turn back up. So we're even seeing a little discrepancy here in the short term. Trying to turn back up with the MACD. We're on top of the moving average of the PMO, coming back up and showing some improvement with the PPO. But with our longer term, TRIX and KST, we are still declining. It takes longer for those to shift. Chicken money flow, another smart money indicator, did decline this past week, but it's still positive. This is another area I've been hanging on to on the daily charts that has been looking more positive. The chicken oscillator, another one that I include in that group, we're above zero and advancing. The force index is positive, and we're going back up with the money flow. We're above 50. That's positive. Since we had an up week, we're above zero here with the rate of change. Going back to the last 50 weeks, we are starting to go up, but be aware, we're getting above this red line, and sometimes this marked a topping out phase. But I put this line on here, so there's nothing magical. I just kind of eyeball this and go, okay, this is a good place to put this. So there's nothing too much to read into it. These lines are mostly just for guidance. The RSI is going back up and not extreme yet. That's positive. The special K chart is still negative and has been since halfway through 2023, even though the daily chart has been positive now for quite some time. We're above the midpoint with the Stochk RSI. That's positive. We're still extreme positive with the Williams percent R. The ultimate oscillator is just starting to get extreme positive, but this could also show good momentum if we keep going up with some of these oscillators. The vortex, this is also what I consider a primary indicator. We had an up week and this went down. We are turning more positive on the daily charts. It's really interesting. After Friday's session a week ago, the green line and the red line were actually right on top of each other. They were giving the exact same reading. And then we had an up day and the green line shot up and the red line shot down. But we're positive here, but it's trailing off. The Copic curve shows that on the weekly chart, we are negative. We're also negative on the daily charts. And we didn't come down to any support level. When we were running into some problems, we came down to this 10-week moving average and bounced up off of that. We're starting to turn back up with our long-term equity put call ratio. When this is going down, you can see that's typically when the S&P is going up. When this is going up, that's typically when the S&P is going down. So if this continues to turn back up, and it's been really choppy lately, we want to look for longer-term trends than just little blips up or down. Then we take the VIX and then take a 3-month average of the VIX. This is still declining, and that usually is more positive for the market. Looking at the trend with the hike in ASHI, we are positive on the weekly chart. We're positive on the KG chart. We're positive with the Renko, even though it redrew. And we're positive with the 3-line break. And we're seeing those same things on the daily charts. The trend is there. It's some of the internal things on the daily charts that are causing us some concern. The ease of movement, we did tick up and we're above zero, so that is positive. We didn't see any new X's or O's drawn in with the point and figure chart. The last signal was triggered with a double top breakout on May 13th. This is another momentum study. In the long term, we're starting to flatten out. We're seeing a little bit of an improvement in the intermediate term as well as the short term. This is a 50-day cycle that I came up with, I don't know, a while back, couple year, 2 years, whatever it was. I just was playing around with this one day and I said, okay, here's a high, here's a low. And I just went with this 50-day cycle. Well, we just had a new one start on June 4th. And don't read too much into that. Yeah, sometimes it picked the bottom and sometimes it picked the top, but we just use this as a reference. At least I do. We are positive with the Elders Impulse system after being neutral after last week. So this is looking longer term positive. And this is great for the daily chart. We switched back to positive with the parabolic SAR. We're positive on the weekly chart. This is another primary indicator. And then looking at seasonality, just going back to 2020, this is the month of June where we're up 0.7% and we're up about 80% of the time over the last 5 years. This is looking at the different indexes. Here's the S&P just coming off of setting all-time highs. Not seeing that. This is a somewhat of a negative divergence with the mid caps, and the small caps just continue to chop along sideways. The Dow is in an uptrend. It's fallen below its blue moving average here, which is 13 weeks, but it did try to bounce back up this past week. The NASDAQ setting all-time highs. That's looking solid. The NASDAQ 100 also looking solid on a trending basis, just coming off of setting a new high with the QQQs, which is the NASDAQ 100. The mid caps kind of chopping around, not really breaking on through to the other side here. Small caps just been going sideways in a range for 2024. The NYSE pulling back a little bit, but coming off of recent all-time highs. This is a daily chart of the Wilshire, also just coming off of all-time highs. And I know this is a daily chart in a weekly video, but I like to show this. This looks like the 50-period moving average was the support level that we bounced up off of that. We didn't quite hit it with the S&P. We didn't hit it with any of the other indexes. And usually the Wilshire isn't what the market focuses on, but we seem to actually hit this and then bounce up off of that. All stocks continue to be in an uptrend. And then the big software companies, though, these aren't doing all that great right now. And if we're staying below these moving averages, we could actually see a death cross. FANG stocks, these are the big mega cap: Facebook, Apple, Amazon, Netflix, Google, and I'm sure Nvidia's in there too. Coming off of setting all-time highs this past week. ARK, not looking so good here. It's actually dropping below the moving averages, and on a long-term basis, we could see a death cross. And I feel bad for people because Cathie Wood has this philosophy, and she was the rock star there for a while. Now people just seem to love to bash her. I feel bad for the people that got in because they were making their decisions as this was going up, and it seemed like a great investment, and they would watch her videos and everybody seemed happy. Well, then we ran into some problems, and now everybody's bashing her, and they're losing a lot of their retirement. And I want everybody to make money in the market. I don't get off on bashing other people, and so I kind of feel bad for folks. This is the weekly chart of the bank index, where we did pull back a little bit this week. We're coming down, but still above 50 with the RSI. The momentum could be starting to turn over negative here. Then deposits, we're actually seeing money going into banks, even though this went down. Again, another government chart. See the line going down, but the number going up here. Go figure. All right. And this is just a raw number. This isn't like year over year or anything like that. And it's supposed to, maybe because it's seasonally adjusted. All right, here is Dow theory in traditional form, where I don't do a lot with this on the weekly chart. I mainly focus on this on the daily charts, where we're coming off a little bit of weakness here with the Dow. The transports are going sideways. The utilities have been just screaming up, and now we're seeing some profit taking there. Looking at the CRB index in an uptrend. This could be inflationary depending on what we're looking at. Oil dropping down. It came down into the low 70s, but ended up closing in the mid 70 region, which would be 75. Copper had been really going higher, but we're seeing a lot of profit taking right now. The dollar is still in a longer term uptrend. It's still in an uptrend on the daily chart, but it has been pulling back. Gold is just coming down, and a lot of the gold people out there, no matter what happens to gold, they can always come up with a rationalization if it goes down. And they they self-proclaim themselves to be geniuses when it goes up. So it's pulling back here on the weekly chart. Silver also pulling back after really seeing some highs. Looking at bonds, where we still are positive when we look at the total bond ETF based on price. Stocks are still outperforming bonds on a monthly chart. We're negative here when we take the 1 month yield and subtract the 3 month yield, and that's more normal if there is such a thing. This is, and I updated this. I don't know why this didn't change. This is a daily chart of yields where we had been coming lower, and that was giving some support to stocks, but then we really spiked up on Friday. This is a weekly chart looking at US, UK, German rates actually ticking down for the week. Japanese rates are much lower, but they also ticked down this past week. Then this is an intermarket analysis chart where we now have stocks in the lead. Woohoo! Imagine that. And then gold has now dropped to second place. Oil is now in third place. The dollar is in fourth place, and bonds based on price are negative. Then we do some ratios between the NASDAQ 100 and the S&P. The NASDAQ 100 is outperforming, and both are coming off of recent all-time highs. The S&P 100 really outperforming the S&P 500 right now. Growth to value shows that growth is outperforming. Gold to the S&P, since gold has been pulling back and stocks are doing a little bit better, we're seeing this ratio going down, even though we've seen a recent golden cross. Gold to the dollar, where gold had been going up, the dollar is now seeing some weakness, but we're seeing this ratio coming down as there's been some profit taking in gold. This just shows the bonds are underperforming stocks on the weekly chart. This is low volatility to the S&P. These continue to go down. Discretionary, this is a concern. We actually came down on a longer term basis and we're seeing a death cross. This means that discretionary is now underperforming staples. When we're in a growth phase of the stock market, we want to see discretionary doing better. When we're in the defensive stage, staples do better. And you can see, going into 2022, how this ratio was really going down as staples were outperforming. Well, we were doing better, but now we're starting to see some weakness. We just want to keep an eye on this. Energy, which has been bouncing back when compared to tech. Well, tech's been going up and energy's been going down lately, and it's still underperforming with a longer-term downtrend when we compare energy to tech. Then we look at the NYSE breadth thrust. This, I just show it every week. We're still working off of the signal that was generated in October 2022. We did miss a swag NYSE breadth thrust by 1 day, but I still like to keep an eye on this chart. There's the Horchak method, which is a long-term signal. It's still on a full-on buy signal. Looking at a long-term weekly version of the S&P 500, going all the way back to the 1987 crash, we're still well above this trend line. This is a shorter-term blow-up of that same chart. We look at the new highs minus the new lows on the NYSE and then take a 50-period moving average. We are declining, showing some weakness, but we're still above zero, so we continue to be positive. This is just looking at the S&P, declining, but still above zero. The NASDAQ 100 weekly chart, still above this trend line going back to 2009. And this is one of the charts, and I'll be talking about this in the What to Watch video too. I got this idea from a perma bear because we set a really high reading back in 2000. This was when the dot-com stocks topped out. And then here's the dot-com crash. Took us, I figured it out one time, 22 years? No, 19 years to get back up here. We hit that, and then that was at the end of 2021, and then we started coming down. Okay. Now, as we were going back up, the perma bears are just salivating, saying, we're coming back up to this level. We're going to hit this and then turn and tank. Well, look what's happening here. We're actually going up and setting a new high with this ratio. So that kind of throws a little bit of water in their face, which they get that a lot. If they're, the market tends to go up about 70% of the time. And these guys are bearish 100% of the time. So, I mean, they've got like baseball stats, they're only right about 30% of the time. Anyway, but I don't know what they're going to say about this. They'll come up with some kind of rationalization, I'm sure. That's what bothers me about the perma bears. No matter what positive things you throw their way, the market's still getting ready to just fall apart. Where I like to be a realist when it's going up, okay, it's going up. There are times when it goes down. That's just a fact. We look at a similar ratio here of the QQQs to the small caps, also coming up and actually breaking above these previous readings. Semiconductors also breaking out above these previous high readings when compared to the Dow. This is a little bit of a concern. The NASDAQ new highs minus the new lows taken on a cumulative basis. We were starting to turn back up. Now we're flattening out. We want to see some more follow through with this. We want to keep an eye on the 3-month yield because this really started to tank as we were going into the great financial crisis. Going sideways now is like, okay, we'll take that. But if this really starts to trail off, that might mean some bad things are beginning to happen. Now there's this other perma bear thing called the Hindenburg-Ullman. And on the next slide, this is an explanation right here. If you want to pause this and look at it and learn all this stuff, there's really 3 parts to this Hindenburg-Ullman thing. Stockcharts.com has created their own indicator, which takes all three of these and puts them together. We saw a spike back in February, and then we came back down. And then it was not confirmed because there has to be a second spike within 20 trading days. That did not happen. Well, up until about the end of June, we did see a spike, and we've got until about the latter part of June. If we see another spike, then that will be a Hindenburg-Ullman, and the perma bears, they're going to be partying like crazy. Because other times when this happened, yeah, we ended up going down here. This was in 2019. This was the COVID crash and the start. This was at the end of 2021. So we want to just keep an eye on this. When you take single spikes, this has a very poor rating. But at least over the last few years, when it confirms itself, we need to at least pay attention to this. Seasonality, and I have a lot of different charts here. This is put out by Dan Bird. His email address is in the description. He sends out a weekly email and includes some charts and has a free PDF that you can download and look at. And to me, it's free. So, but this red area, this is June, where we do see some positive seasonality until we get more into the latter part of June. This is going back to 1950 for just election years. This is where we were coming up back in 1982, and then we seem to have bottomed and are going up. I've been showing this chart for a while too, where we seem to be showing that same basic pattern. So that's longer term positive. When we look at May during an election year, we're up 15 out of 18 times, down 3 out of 18 times. Great track record with a return of 1.3% for the month. Where June doesn't perform as well, but it ends up being positive. When we go on a monthly basis back to 1950, then this is looking on a world basis where June actually underperforms. And then there's two areas in this chart. This is a Carson chart, and they came out with the May to October being the worst 6-month period. Well, now we're into the June to November, and we're not much better, but it is an improvement. This is looking at June, July, and August, where during an election year, we often see some rallies on a seasonal basis. May not happen this time, but it has happened in the past. These are put out by the Stock Traders Almanac, where we're coming up into the end of May now and now starting to get into June, where we tend to see positive seasonality. If you take out 2020, you just don't count that like it never really happened. Then we seem to be following some kind of a norm here. So if you tweak the numbers around, you can get it to say pretty much whatever you want it to say. This just came out on Twitter in Friday by Stock Traders Almanac, where when it says bullish April is down, which it was, and bearish May was up, which it was, the third quarter tends to be weak. That's what the seasonal statistics are saying when we go back to 1950. This is that same chart showing that same kind of a thing. This lovely purple line here, this is what the S&P has been doing. And then we take all the election years in black. Red is when the top first quarter of election years. So if you just pick and choose like a buffet, then we perform like this. When the sitting president is running, that's the green line, and that's what's happening. And then when we take the aggregate cycle, this is kind of everything together. That's the blue line. And then when we have a down April and an up May, that's the gold line, where we might see some weakness from September into October. Anything can happen here, folks. We just pay attention to this as a guideline. Then this is looking at the NASDAQ, because sometimes we see it does okay in June, but not all that great during an election year. It does bounce up in July, and then as the conventions are happening, we see some weakness. Then it starts to take off more in August, according to this chart. Then we also compare it to 2012 because we've been kind of following that. That's the dark blue line. They started off by thinking, well, we're going to follow 1968. Well, we've been going in the opposite direction. Just because 1968 was a hell year for America. The only thing good that happened was we sent 3 astronauts out to the moon, and they went around 10 times and came back. Incidentally, as I record this, Anders, one of the 3, he's the one that took the famous Earthrise photo. He lives in the Seattle area, which is where I was from. He was just killed in a plane crash at 90 years old. So thank you to a true American hero. and he lived a nice long life. I don't know, being an astronaut and a pilot, that was probably the ultimate way to go for somebody like that. And looking at this other study here, where we look at June, July, and August, which tend to be positive during the fourth year of a presidential cycle. Also, you can take this a number of different ways. If you go back to 1950, we're up a little bit. The past 20 years, we've been down. The past 10 years, we've been up. And during an election year, we actually see things improve in June. And we see kind of that same follow through into July. And looking at here, June, July, and August are historically the best 3 months of an election year. We're just focusing on June now, where it's up 75% of the time with a return of 7.3%. Then it trails off, but we still get positive returns as we go through the summer. Then this is another one, the median 2-week S&P returns going back to 1950. The first half of June is not all that great, but it's not negative. So thank you. I really hope you found this helpful. Please feel free to give me any kind of feedback, positive or negative. And if you desire to, check out the SPX Investing Program and the link that I have, and just try it out and see if it's anything that would even be of interest to you. I really hope you have a great weekend, and I will talk to you in the next video.